Okay, good morning, students. Today is the fifth day, and we are covering the topic foreign exchange exposure and risk management, the paper 2, Advanced Financial Management, and I am CA Pravesh Hagi. Good morning to you all. Again, good morning, Devraj. Good morning, Mansha. You're already there. Good. So today, we are going to, yesterday we covered Viraj also. Good morning. So we are going to, yesterday we covered futures. Today, we are going to do some more good questions on futures, which came on your CA final exams, as well as we'll try to cover the fag end about the options. And then on the ultimate day, we are going to cover options, some questions, more questions, and then the fate of contracts and no throw in, both throw account. So that would be our, way we will be proceeding. So, so just to, give an idea, good morning, Mohammed. Good morning, Satish. Yeah. So, we covered about, what are futures. So we must know, the difference between forward and futures contract. So the difference is basically contract size. Forward contracts are customized. That means it can be tailored according to your requirement with the help of a bank because they provide forward contracts to you. And future contracts are standardized. That means there are standard lot sizes for, US dollars, or pounds or sterlings or yens, and then the trading is informal over the counter. In case of forward contract, you go to the bank or you call up a bank to book a forward contract. But in case of a futures contract, it is traded on exchange. So here you have to go to the stock exchange to take your positions both on futures and options. Then the participants, who are the people who are there in the forward contract? Banks, brokers, multinational companies. Public speculation is not encouraged here. And in case of futures, banks, brokers, MNCs, qualified public, then we have public speculation is encouraged here. So people can, speculate in currencies. Now, we talk about settlement, a single pre-specified contract. When you enter in a forward contract, it gets, settled on its due date. Fine. So you will get the money according to the forward contract you have taken. Now, in case of futures, there is a daily settlement mechanism and a final settlement. Now, the daily settlement and final settlement happens, daily settlement happens on a daily basis. So if you have taken a position and if you are making money, the money will come to your account. If you are making a loss, then money will flow out of your account. So that's called daily settlement, and it is also called mark-to-market settlement. So basically the purpose is that there is no counterparty risk and the settlement happens, without any issues. The final settlement happened basically in India on the RBI spot rate, which they announced. And normally world over, the spot rates are used for the final settlement of futures. Then, so that means, there is a daily settlement and a final settlement. Now, daily settlement is basically called the mark-to-market settlement, which means that if you are making money, then, you will get that money in your account. If you're losing, till you hold the position. So that, at the end, everything is settled and there's nothing much to receive or pay to you, so that you are, settling the accounts every day for the stock exchange. So risk, there is a counterparty risk is present in case of forward contracts, okay? Because the other party can, dispute your forward cover or something. It can happen if you're taking it from a non-institutional body. But in case of futures contract, exchange provides guarantee of settlement and hence no counterparty risk. Because as we know, the stock exchange collects the margin when you enter into the trade, and there is always a daily settlement which is happening. So that ensures that there is no counterparty risk. Then marketplace, worldwide network, okay, and that means you can do it on the basis of this thing. And in case of so worldwide telephone network, so you can book your order on a telephone. And in case of the marketplace for futures contract would be the central exchange floor with global communications. That means you have to book on to National Stock Exchange or Bombay Stock Exchange or New York Stock Exchange or London or any wherever you are taking positions. Okay. So, so good morning, Shruti, you're there. Sailesh, Mane is there. Namrata is also there. So let's start with some questions today. And we are actually, I'm just telling you that this is the most difficult part of the journey of our understanding about the currency markets. And the futures and options, tend to be, quite difficult for people to understand, some of them. But if you understand, they become very, very easy. So only here is that your concept should be absolutely clear. Okay. So I like to, my intention is to make you understand the concept. Now, XYZ Limited is an export-oriented business house based in Mumbai. Okay, so this is an export-oriented business house which is based in Mumbai. The company invoices in customers' currency. That means this is a normal thing. The customer will always like that, it should be their invoice should be raised in their currency. So its receipt of US $1 lakh is due on September the 1st, 2009. So that means it is going to receive $1 lakh when on September 1st, 2009. And the information which is given to you is on June 1, 2009. Okay. So this guy is, looking at the information of the stock exchange and the forward quotes on 1st of June, 2009. Now he looks at these quotes. Now, if you can look at these quotes, they are actually indirect quotes and not direct quotes. Okay, fine. So don't get worried about it. It's very simple to solve even using indirect quotes. So US dollar versus rupee, on the left hand side, the spot rate is 0.01240. So you can always make it direct by 1 divided by 0.02140, but you don't have to do that. Okay, 1 month forward is given and 3-month forward is given. Now it is 1st September and you're going to receive your money. It is 1st of June and you're going to receive money on September the 1. So that means 3-month forward rate will be applicable to you. Similarly, the US dollar versus rupee, June quote is given, okay, and September quote is given. So September quote will be basically more valid for you because you are going to take the positions in the September month. So I told you that whenever you take positions in the futures contract, you go just to that month in which you are going to either receive the money or have to pay the money. So you don't have to worry about the June contract at all. The contract size is given in rupees, 4,72,000. Normally in India, the contract size is in dollars, which is $1,000, but they are given in rupees, no problem. So then, you have to pay a margin, which is called the span margin or the exposure margin in India. So initial margin, June is 10,000, September is 15,000. Okay, so the September initial margin will be relevant for you because you have to take a call for September contract. Okay, and the rate of interest are given 7.5% and 8%. Okay, fine, because you're going to deposit this initial margin. It's going to be settled only at the end of the it's going to be settled on 1st of September. So that means you will work out some interest outlay, assuming that you have borrowed some money or the opportunity cost of capital. So I've just put these numbers again. So they are red, numbers are basically the numbers which we are going to use to solve our problem. So now the question says on 1st September 2009, the spot rate US dollar versus rupees is 0.02133 and the currency future rate is 0.02134. Comment which of the following methods would be the most advantageous for XYZ Limited: using forward contracts, using currency futures, not hedging the currency risk. Okay, it may be assumed that the variation in margin would be settled on the maturity of the futures contract. So that means it's assumed that the settlement will take on the maturity of the futures contract. Now, in India, it happens basically on the 2 days prior to the close of the month. Anyway, that's just some information. So let's talk about first the forward rate option. Now, receipt using the forward rate. So please, I'm going to solve it and you are going to say, yes, we have followed, so that I feel that you have understood. Now, 3 months forward rate, rupees is so many dollars. Okay. So that means, it is given in an indirect quote. So we need a dollar quote, but we have a rupee quote. So we can, no issues, we can even divide and calculate the rupee value. So $1 lakh divided by 0.02127. So that means he is going to get 47,01,457 rupees in a forward contract. So it's pretty simple that he gets 47 lakhs by using the forward rate options. Now, of course, we can divide it by 1 divided by 0.0 and calculate the rate. So it comes to rupees 47.01457. So even if we multiply, we get the same answer. So we can either do in both the methods and we will get the same answer. So please confirm, have you followed? Then receipt using currency futures. Now, this is the toughest part, but very simple. So don't worry about it. So I'm going to explain that. The number of September contracts needed is, there is a 1 lakh exposure in dollars, and the rate of $1, 1 rupee is given to you in terms of dollar. So that means 1 lakh divided by 0.0. So that means you have an exposure of number of September contracts you require. It will be 47 lakh 20,000 in terms of rupees. You have an exposure divided by 4 lakh 72,000, which is a contract size, which is given in the question. As I told you, in India it is $1,000, but in question it is given in terms of rupees, which is 4 lakh 70,000. So if you divide, you get exactly 10. So that means you have to take a position in 10 contracts. Okay. Now, initial margin is payable upfront. So you have taken 10 contracts. Per contract, initial margin is rupees 15,000, which is given in the question, the September period. Okay. And that means you have to deposit 1,50,000. Normally, now, I explained to you that, you have to, if you are an exporter, so you take a short position in dollars. Okay. That means you sell futures, but as exporter. But since the ports are indirect, he has to take a long position in INR. So that's a difference. Okay. So the difference here is basically because yesterday when we covered a question, which was basically based on that you have to take a position in dollars. So we have, sold futures. So here you have to, he has to take a long position. That means he has to buy futures here. Okay. So remember, it depends all upon the quotes. If it's a direct quote and you're an exporter, so you have to take a short position in the foreign currency. And in case if it is, indirect quotation, then you have to take a long position in the home currency. Okay. So, so that's the mantra. Okay. So remember always that. So I'll keep repeating. So we'll be doing a lot of questions based on that. So by the end of it, you will become an expert. So he takes a long position on rupee for 10 lots. Okay. So that means he has purchased, a futures options. So long position means you have bought it. Okay. If you take a long position, that means you are bullish in rupee, because the exporter would be making money only when the rupee depreciates. But here you're bullish because you want to gain in your long position. Okay. Though in your actual position you'll be losing, but you have taken a long position, just the opposite position what you have in your export transaction. So on September the 1, close at rupee 0.02134. So on 1st September, the future position closed at 0.02134, and this is given in your question. Okay, I'll just take you to the question again to show you where it is given. So so on 1st September, the spot rate is 2.9, and the currency future rate is also given. So in fact, I think I have marked it at the bottom. Okay, so no, so it is not there anyway. So it is closing at $0.02134. So that means when he takes a long position at $0.0218118 and it closes to 0.2134. So that means it has gone up by how much? $0.00016 per 1 rupee contract. So he makes a gain. Since he bought it and then he sold it. So when he bought it, it was $2118. Now when he's selling, it is 2134. So you find that the 16 basis point increase in the dollar rate per rupee. So that means if you're taking a long position, you're bullish on on rupee, and the rupee has gone up in terms of dollars, so you make money. So he makes a gain of $0.006 per 1 rupee per contract. Okay. So if we want to convert this into dollars, how much gain he is getting, because the gain is 0.0016 per dollar. So multiplied by 10, multiplied by the contract size. So he gets a $7.55. So I think my good morning. Okay, good morning, Devraj. Good morning, good morning. So he gets a $755.2. Now we want to convert, in terms of rupee, what is this gain? So we will again use the spot rate. Now we know the spot rate is given in the question, which is 0.0213. So at the end of the contract, when the contract expires, he is going to get $755, but it will get converted into rupees and paid to him. So he gets 35,406. Now, this can be cross-checked at the bottom, which is written here. So you can check, you can convert into rupees and then, minus this, and you get 0.34 rupees. So that multiplied by $1 lakh gives you rupees 5,400. Okay. So when he took a contract, he was, the contract closed at, 47.2143, and he took a position at 46.882. Okay. So that means, sorry, here basically, the contract was 47.2143 when he took a long position, and then it closed at 46. So that means he gained this much of rupees. So we're just skipping to that. So actually, you have to work it like this to have, avoid any confusion. Okay. So receipt using currency futures. So margin will be released in September. So whatever margin he has paid, he will get. He has made money in the futures trade. So interest cost on margin for 3 months, which is blocked for 3 months, which is 1,20,000, because he paid some margin. We show the calculation, and he pays 8% rate of interest for 3 months. It comes to 3,000 rupees. Okay, so he gets 3,000 rupees. He has to. That's a cost of his, blocking in money for margin for 3 months. Since he had to pay 1,20,000 rupees, okay, and actually he had taken 10 contracts. For each contract, he was paying 15,000. So that makes 1,20,000, and the rate of interest is 8%. Remember, when I showed you the question, it was 8%. You can check your, assignment also, and it is blocked for 3 months. So he has to pay. That means he has to incur a cost of 3,000. So this is basically an opportunity cost, or he may have taken some, overdraft from the bank. So he might be incurring. So exporter will get $1 lakh on 1st of September. Now, what will happen on 1st of September? The exporter is going to send him the dollars, and his dollar will be received by the bank, and the bank is going to convert them at the spot rate, which is given in the question. So that means how much he's going to get from his banker in his bank account will be 46,88,233. That means $1 lakh divided by 0.0213. Now, so his net receipt would be basically 46,88,233, which is getting from his bank. When, he gets his money from his customer, he pays him $1 lakh. The bank says, okay, we have received your $1 lakh. Today the rate is 0.012133. So we will credit your account with 46,88,233. So that's the accounting language. So which means that he's going to receive this money. Okay. Now he has got, 35,406 on his, futures position in the stock exchange, minus 3,000, which means this is the interest on the margin. Initial, he has paid some margin. So that's a cost. And so that means his total, net receipt will be 47,20,639. So this is using currency futures. Now, let's talk about all the methods. So first was the forward, where he got 47,01,000. Futures, we have just calculated. It is 47,20,000. Then unhedged. So what we'll do, we'll take $1 lakh and divide by the spot rate on 1st of September, which is given in the question. So if he doesn't take any, hedging position, so he's going to get 46,88,000. Now, in futures contract, you find that he's getting the most advantageous situation. Okay, so that's all. Okay. So now, since we'll be doing some more questions of a similar type, okay, so since I would like to do most of the questions which are there in the study material, okay, in case if you want, I can get up on the board and just also explain, but it will be advisable that we do more questions. If they are clear, then we'll keep moving ahead. Okay, otherwise I'll, go to the board and explain the calculations also. So let's talk about the export limited and export-oriented unit invoices in currency of a similar question, okay, almost similar question. It is expecting a receipt of $2,40,000 when on 1st of August 2022. So this is a recent question which came, in 23, I think May, your CA final exam, for the goods exported on 1st May 2022. So these types of questions have come at least 5 or 6 times, in the last several years in your CA final, and they're pretty easy. Okay, so he's basically what? An exporter. What he's going to get? How much? 2,40,000. When? 1st of August. Okay. And when he exported the goods? On 1st of May. So, he went to the stock exchange and he saw some quotations. So he found that the spot rate was in the exchange rate, USD versus INR. So again, this is an indirect quote. Okay. The spot rate was 0.0125, 1 month forward, 0.0124, 3 months forward, which is relevant for us because he's going to receive money on 1st of August. Okay. So the 3-month forward contract will become the important one. Okay, so I'm going to repeat, okay, Namrata, because we are going to do 4 questions of the similar type, or all the questions of the similar type. So don't worry about them. If you have missed one, you will be able to cover yourself in the second. So here, the May contract currency futures rate is 0.0126. July is 0.0125. Now he's going to get his money, say, on 1st of September, I believe. So the rate for, 1st of August. So rate of July is important for him. Okay, if you look at this thing, so he's going to get his goods on money on. It's written on 1st of August. So he's expecting to receive the money on 1st of August. So in that case, the July 30th, which is the expiry contract, will become relevant. So in futures, you have to just worry about only the month in which you are going to take your position. So forget all other months. There are always 12 months contract which are given by the stock exchange. So look for the relevant contract month, which is July. Now you are going to receive money in July. So you should be focusing on currency futures of only July. So that means the rate, which was the last traded rate, was 0.0125, or I would say that this trade he is going to, book his futures order. The contract size is given as 6,40,000. Sir, Prashant, good morning, sir. In interest on margin calculation, what interest rate will be? Take the borrowing rate or the deposit rate? It has to be borrowing rate, my dear Prashant, because here only one rate is given. So, you have to take a borrowing rate. He's not going to deposit the money. Of course, he's going to deposit the money, but he's going to borrow on the other hand, okay, from either a bank or somewhere. So he deposits that money with the stock exchange, but the cost, so he's not going to get any, it's not a fixed deposit. Okay, he's not going to get that interest from the stock exchange. So he is going to arrange that money, okay, and deposit that money. Now, how he arranges, he takes a bank overdraft, or he takes some personal loan or wherever. So there is always an interest cost to the money. So that's why we calculate that. Okay, so it's a borrowing rate. So contract size 6,40,000. So here the contract size is 6,40,000. And normally I told you the contract size for rupee dollar is $1,000. But these are given in indirect quotes. That's why the contract size is given in rupees. Okay. Now margin requirement for May 15,000, August 26,000. Okay. And rate of interest 9%, 8.5%. Of course, it was a July contract, but they have written August, so we'll take August only. Okay, fine. So because it's going to be settled on the last day of July, so we'll presume that this is a July initial margin. Okay, though it may be mentioned August here. So the rate of interest is 8% in India. So 8.5% is the borrowing rate. So we go to the bank and take money from the bank, so they are going to charge you 8.5%. Okay. Now, on 1st August, yeah, we'll do that. Mansha, don't worry about the assignments. So, yeah, I have already, the assignments has been uploaded, so it is there with you, and I'll share everything, okay? Fine. So, on 1st August 2022, the spot rate USD versus INR is 0.0126, and these all questions are coming from your study material, okay? So in case if you haven't received this assignment, then you can just refer to the study material. So these questions are all from your study material, and they've been always solved there, but I'm just going to explain them a little bit in a more fashion so that you understand the concept. So don't worry about Mansha, it is already there in your study material. Okay. So on 1st August 2022, the spot rate USD versus INR is 0.0126. Okay. So, and the currency future rate is 0.0125. Now, this is the settlement rate on 1st August. Okay, so whatever position you take, they get settled at the future rate or the spot rate. Generally, the spot rate and the future rate on the expiry is normally the same, but there can be always some differences because if you're closing your position just before the expiry, it may happen the rate is are slightly different. Now, suggest a suitable approach to export limited that would be most advantageous out of the following methods. Forward contract, currency futures, no hedge. Okay. Assume the variation in margin would be settled on the maturity of the contract. Okay. So that means you're going to get either the loss or gain only at the end of the contract. So, so now let's talk about, the first method. So please listen it carefully again. If you have not understood the futures properly, so this is one more chance, and then you will get another chance also. Then all the questions in futures almost similar. Okay, fine. It is expecting a receipt of USD 2,40,000 on 1st of August 2022 for the goods exported on May 2022. So that means it is going to export goods on May, in the month of May, but is going to get the money only on 1st of August 2022. How much money? 2,40,000. So we know the exchange rate, 3 months rate has been given in the question. Okay. So which is basically 1 rupee is equal to so many dollars. So this is an indirect quote. Okay. So in this case, either we convert into a direct quote and we say how much dollar is equal to how many rupees. So we can even do the reciprocal, or we can simply divide and calculate in terms of rupees. We'll get the answer. 2,40,000 divided by 0.0123. So that means he would be getting, if he takes a forward option, so he will be getting 1,95,000, 1 crore 95 lakhs 12,195. Now let's go to the futures part, the most important and the difficult one. The number of contracts needed would be, first we have to find out how many contracts he is going to, take a position. So in futures, when you go to the stock exchange, so you have to mention the number of contracts and while you take a position. So yesterday I took you to the stock exchange and showed you that the number of contracts needed would be 2,40,000 dollars divided by the rate of the month, 0.0215. So if you look at the rate here, so which is given here, so which is marked in red, July. So this rate I have taken, because we are actually taking a position in this month, and this is the contract size and $1 lakh. So we take $1 lakh multiplied by 0.0125 divided by 640,000. So we'll get how many contracts he is going to take a position. So which means the number of contracts needed will be $2,40,000 divided by the quotation. So it will convert everything into rupee. So then we divide that rupee calculations with 6,40,000. So we'll get 30 number of contracts. Okay. Now initial margin for 30 contracts is 30 lakhs, 30 into 26,000. Okay, which is given in your question. For this month, you have to pay 26,000. So there's the question coming. Sir, what is the currency future rate? What is currency future rate is given exercise? Is given in exercise which? 1 month, 2 months. So I'm not getting your question. Sir, what is the currency future rate is given? Exercise 1 month. Now, if the future rate is given 1 month, 2 months, so we have to ignore, we have to just go to the relevant code. Okay, so let me just take you to the question again and see what you're asking. These are the rates which are given. So on the left-hand side, you have the exchange rates, the interbank rates, or maybe the merchant rates, and in the forward market, and on the right-hand side, you have the currency future rate. So basically, to assess, which market you should go, either you should go in the forward market or go into the currency futures market. So the forward market, you have to simply go to the bank. So here you are going to, since your information is given on 1st of May, and you're going to get your money when, if you just check. So you're going to get your money on 1st of August 2022. So, which means 3-month forward rate would be applicable to you because it is, 1st of May. So May, June, July. Okay. So that means 3 months. On the 1st of August, you will complete entire 3 months. So 3-month forward rate will become relevant for you, forward rate, and 1 month rate or the spot rate is not applicable to you. You're going to ignore that. And in currency futures also, it is the July contract which becomes very important for you. So you're going to open the July contract, go to the stock exchange, open the July contract window, and take positions in that contract. So if you have not followed, please watch my yesterday's lecture. So I've taken you to the stock exchange to explain that. Okay. Now the rate is also given, the expiry rate is given, which is, which is 0.0125 here. If you can see, this is the rate of the stock exchange and this is the spot rate. Normally, the rate would not differ, they will be same, but of course, a slight difference can always be there, and it can be on two accounts. One, if you are closing your futures before the expiry, okay, that can be one situation, or it can be the rate which is given by the spot rate given in online rates can differ from the future rate, which is the RBI rate, which is announced by RBI. Now that rate can have a slight difference in the rates which you get on online quotes. Okay, so that's why there is a difference. It can be. So these are the two ways only the difference can be there. So now, so this we know that the initial margin payable is 30 contracts and 26,000. So if you can just go and check what was the initial margin, he has to pay 26,000 August. Now I told you that the month return is August, but it pertains to the July contract. Okay, and rate of interest is 8.5%. So we use the same information here. Okay, so what he's going to do? He's going to buy futures. Okay, now this is an indirect quote. So basically, in an indirect quote, you do just the opposite. Okay. Now, you are going to buy futures on 1st of May, and then you're going to close your futures on 1st August or sell your futures on 1st of August. Okay, 30 contracts. So basically, when you are, an exporter. So in this case, you are an exporter. So you are long in dollars. So you take a short position in futures, short position in dollars. But here, you can't take a short position in dollars because the rupee is given. So you have to take a long position in rupees. So it is equivalent. Okay. So either you take a short position in dollars or take a long position in rupees. So it gives you the same result. So since here the indirect quotes are given, so you can't take a long position. You can't take a short position in dollars. So you have to take a long position, or you have to buy futures. So you're going to buy futures. So when you bought the contracts, the rate was 0.0125. But when you close your position, okay, on 1st of August, the rate was same. So it is given in your question. The rate the future rate was 0.0125, 30 contracts. Okay. So if you can just look back, I'll just show you here. If you don't have the assignment, okay. So it is showing you that here, particularly, if you, stop here. On 1st August 2022, the spot USD INR is 0.0126 and currency future rate is 0.0125. So when he closed the position, it was 0.0125. When he took his position, which was here, in July month on your currency future, the rate was 0.0125. So he makes no gain, no loss in the stock exchange. Okay, fine. So in case if you're not having the assignment, so I'm just going to show you the questions again and again. So that means he doesn't make any money. Okay. So so if you look back here, so I've given on 1st August 2022, the spot rate USD INR is given, which is 0.2. Okay. So he closes his position on that. Now let's go to the second part of it. So no profit or loss on the futures position. Now exporter, he is going to get 2,40,000 from his foreign counterpart. He is going to get $2,40,000, and the bank is going to tell the exporter that they have received 2,40,000 in the exporter's behalf. So we are going to convert that into rupee and give you that money in your bank account. So the rate is 0.0126. Okay, fine. So he is going to get 1 crore 90 lakhs. Okay, so net inflow would be 1 crore 90 lakhs 47. Now, since you have paid a margin, okay, since you have paid a margin, so there is an interest cost to it. Okay, so that is 7,80,000, and rate of interest is given as 8.5%. For 3 months, your money was blocked. So you assume a 16,575 as a cost, even if you have not incurred a cost from your pocket, but you need to take it. So to understand, because if you're using your money, you could have deployed it for your business. Okay, so you're blocking your money in taking a position. So you have to take an opportunity cost for that. So 16,575. So which means the net inflow after considering the interest on margin would be 1 crore 90 lakh 47,000 minus 16,575. So that means your net inflow would be 1 crore 90 lakhs 31,044 rupees. So again, to give a point that why we take margin interest, it's an opportunity cost. Either you take a loan from the bank or an overdraft from the bank, even if you're using your own money, you have to still consider 8.5%, which is the rate of interest in India, because you're deploying that money by blocking your money in the margin. You could have used it for your business purpose. So there is always a opportunity cost involved. So you have to take that for assessing how much, which option you should go for. So here you're getting 1 crore 90 lakh 31,000. So no hedge. Now, if he doesn't take any hedge, then okay, whatever is the spot rate, will be getting money on that basis on 1st of August. Now, the spot rate on 1st of August is been given as $0.00126 per rupee. Now you're getting 2,40,000. So you're going to simply divide and find out the money in terms of rupees. So it's going to be 1 crore 90 lakhs 47,619. So on 1st of August, the spot rate is given in your question, which is marked as red at the bottom of the screen. So now, which one is better? Forward contract, you got 1 crore 95 lakhs. In case of futures, you got 1 crore 90 lakhs, 29,000. And in no hedge, you're getting 1 crore 90 lakhs 47,000. So you find the forward contract is the best one. So forward contract is a better option. Okay. So now this is again explained. So let's move to some more questions. So all the questions have a similar settings because they are all futures. Okay. So if you have not followed in one, you will be covering up in the second one. So, and there will be about 5 or 6 questions we'll be doing. So by the end, you will understand the tricks of the trade. ZAC PLC, a UK company, is process of negotiating an order amounting to euro 2.8 million with a large German retailer on 6-month credit. Okay, so this is basically a UK company. They are processing an order which is coming from Germany, and the order is worth 2.8 euros. So the German retailer is going to give a kind of he's going to avail a 6-month credit. So that means you're going to get your money only after 6 months. Now, so this is basically an export order. Okay. Now, if successful, this will be the first time for ZAZ has exported goods into highly competitive market, German market. So the ZAZ is considering following 3 alternatives for managing the transaction risk before the order is finalized. So they have 3 options. So for the first option was given by the marketing head, which says, Mr. Peter, who is the marketing head, suggested that in order to remove transaction risk completely, the company should actually invoice the German firm in sterlings, that is their home currency, using the current, euro pound rate, average spot rate. Okay, so he says take the average spot rate and to calculate the invoice amount. The second was, the CEO of the company, Mr. Wilson. So he is doubtful about Mr. Peter's proposal, and he suggests that an alternate of invoicing the German firm in euros, so invoice them in their home currency of the German company, the foreign currency rather of the country, and using a forward exchange contract to hedge the transaction risk. So he's suggesting that you should go for a forward contract, basically the CEO of the company. Then their CFO, Ms. Karen, is agreed with the proposal of Mr. Wilson. So he has to agree because it's coming from the CEO to invoice the German first in euros, but she's of the opinion that ZAZ, the company, should use the sufficient 6-month sterling further contracts. Okay, so they're nothing but the futures contract in England to the nearest whole number to hedge the transaction risk. So the first guy, Peter, he says invoice, in pounds, okay, on an average spot rate. Mr. Wilson says go for forward, and the CFO says that we should go for the futures contract. Okay. So we know the spot rate is given. Now, what is the amount they're going to get in euros? So the rates are given in pounds. So that means 1 pound is equal to so many. So these are indirect quotes again. So 6-month forward quote is given 60 0.60, 0.55. Now they are in, that means that the pound is trading at a discount to euros. Okay, so they are in decreasing order. So we need to minus to get the rate. 6-month further contract, which is nothing but the futures contract in England, is currently trading at, 1 pound is equal to so many euros. 6-month future contract size is 62,500 pounds. After 6 months, the spot rate and the future rate is given. So look at this question, almost having the same pattern. Okay, fine, but it is involving different currencies, not rupee versus dollar. So you are required to calculate to the nearest pound the pound receipt for ZAL PLC under each of the 3 proposals. In your opinion, which alternative you should consider to be the most appropriate? So first, we are going to use the marketing manager's advice that we are going to raise the invoice in pounds, but it has to be an average spot rate. So proposal of Mr. Peter, invoicing in pound will produce how much? 2.8 million in euros. So we are going to divide the average rate. So average rate has been calculated at the bottom. Okay, so which is the rate which is given in the question, which is 1.1960 and 1.970. So this is given in your question. So we add them up, bid and ask, and divide by 2. So we have 1.1965 and use that for calculating, converting the euros into our pounds, because this is an indirect code, so we need to have to do a division. Okay, and of course, this is the average spot rate, so we don't have to worry about that at all. So we are taking both bid and ask and doing just simply the division. Okay, because the quote is indirect. Okay, so that means they will be getting pound 2.340. Okay, so they will be raising this invoice at 2.340 million. Okay, so let's talk about using forward exchange rate. So proposal of Mr. Wilson, forward rate. So now the forward rate is given to you. Okay, so look at the forward rate in your question. It is given, and we use the quote and minus it. Okay, if you look at the bottom of your screen, so it is given that the spot rate is 1.1960 euros and euro 1.970 per pound. Now 6 months forward points are given 0.60, 0.55. So here we are going to look at the bottom of the screen, just right at the bottom. It is 1 pound will be 1.1960 minus 0060 and pound 1.970 minus 0.005. So that means you will get your quote in terms of euros will be, in terms of pound rather, per euro will be 1 divided by 1.1915. So here we are going to use the bid rate to sell our euros. So the rate is used to bid rate always. Okay, so we are going to use the bid rate. So bid rate is given in your question as 1.1970 minus 0.005. So you get 1.1915. Okay, so we are going to use forward market hedge sterling. This would be 2.8 million is the order divided by 1.195, which is the bid rate. So, the bid rate is applicable to the exporters and ask rate is applicable to the importers. If you are going to get your, euros to the bank, you go to the bank. So the bank will convert your euros into pound at the bid rate. But if suppose these are in imports, so they would have converted at the ask rate, which is 1.1900. So ask belongs to the importers and bid belongs to the exporters. Remember that to do your questions. So he gets $2.35 million if he uses the forward rate, forward contract. Now the important part where the CFO says go for futures, 6 months selling futures to hedge the transaction risk. So this is the proposal. The equivalent sterling of the order placed would be this. So this is the rate which has been given on that day. This was the future price. When you go to the stock exchange, you find that 1 pound is equal to so many euros. So what is your exposure? 2.8 million. So if you divide this for the relevant month of rate, so which is 1.1943, so you will get in converted into pounds, okay, which is 23,44,470 pounds. So we know the contract size actually is given in pounds. So we divide by 62,500. So one lot size is 62,500. So how many lots you have to really go for? So you get approximately 37. So now you can't take in points, so you have to ignore the points and take 37. So if you just take 37 and multiply it by 62,500, that means your total exposure, which will get covered, will be 23 lakh 12,500 and not 23 lakh 44,000. So that means you're under hedging. But if you take 38, you will be over hedging. So the company decides to go for the nearest whole number, okay, which is 37. So that means they are covering the exposure to the extent of 23 lakhs 12,500 and not the full, which is 23 lakhs 44,000. Normally, you take a short position in euro because euro is the foreign currency. Okay, so you would be taking, and you're an exporter, so you are basically you are long on euros because you're going to get money from your customer from your this thing, but you have to take just the opposite position in euros. But here the quote is given in pounds. So, but since the quotes are indirect, he takes a long position in pounds, okay, which is equivalent to taking a short position in euros. So buy futures so he's going to take a long position. That means he's going to buy futures. When you say long, that means buy. When you take short, it means sell. So buy futures, this. Then the expiry rate is given to you. So he'll close at expiry, which is 1.1873. So he takes a buy position at 1.19, but actually the future closes at 1.187. So that means he's losing money in this contract. So there's a loss of Devraj, sir, Devraj again do the question. So don't worry about Devraj. There will be a lot of questions like this, the similar questions. So if you missed one, the second question you can always catch up. So this is the loss which you are making in this contract. Okay. So don't worry about it because all questions have a similar conceptual understanding. So in the question, you are making a loss. So why you are making a loss? Because 6 months for the contract was trading at 1.1943. So you bought futures. Okay. Then when you close the expiry, it was 1.1873. Okay. So you minus them. So you'll find there is a loss because the pound has actually depreciated, in a month's time or in the 6 months time. So it has moved from 1.1943 per euro to 1.1847. So it has depreciated. So that means you are making a loss of 0.0070 per euros. Okay. So total loss on the futures contract will be 37 into, there are 37 contracts. Per contract size is 62,500 pound into the loss in euros. So that means the total loss you're going to make in the futures contract would be 16,188. Okay. So after 6 months, they're going to receive, 2.8 million euros. So that is 28 lakh euros. But he has suffered a loss. So that exclude that loss. So that means in futures contract, you're going to, get 27 lakhs. So net inflow to the company will be only 27 lakhs 83,812. So amount received, how we have calculated, basically, this is the money which your customer is going to give you. Okay. And this is going to come into your bank account. So, but then this will be coming in your pounds. But so in terms of euros, if you see, it is like this. Now we convert this into pounds. So we know sterling receipt on sale of euros in the spot market is would be 1 divided by 1.1873. So that means he will be actually getting only 23 lakhs 44,657 pounds. First we'll be getting 28 lakhs from the customer. Okay. And the bank is going to, his banker in London will be converting them into pounds. Okay. At the spot rate. Similarly, he's losing 16,188. So he has to pay this money to the stock exchange. So which will also get converted at the pound rate. So if we net, he's going to get an inflow in his bank account as 27 lakh 83,000. So which is equal to nothing to pound 23 lakh 44,000. Okay. So which is 2.348. Take more questions. Yeah, definitely. Because we'll be doing a lot of questions on futures, similar type. Okay. So please, if you are missing out something, don't worry. In the next question, we will catch up. So the first proposal, he was getting pound 2.34. Second proposal, A proposal was invoicing in pounds. B proposal was basically taking a forward contract. C proposal was futures contract. So if you just see that proposal B, which is, hedging through forward contract, was preferable because A and C is producing the least receipts. Okay. Now, another addition, further in case of proposal A, there must be a doubt to whether this would be acceptable to the German firm as it is described as a competitive market and ZAZ is moving for the first time to the market. So they would not like, that their invoice should be raised in pounds. So rather they would like the invoice to be raised in euros. So that was the first proposal given by their marketing manager. So maybe it might not be feasible at all in the real world. So that is what I want to say. So now let's move on to exercise number 29. So there is a company called Nitrogen Limited, which is a UK company, okay, is in process of negotiating an order amounting to euro 4 million with a large German retailer on 6 months credit. So this is basically a company, Nitrogen Limited, which is a UK company, okay, is in process of negotiating an order amounting to 4 million with a large German retailer on 6 months credit. Now, this question is exactly the same, only the figures are getting changed and the name of the companies are getting changed. So you're getting so many questions in your CA final on futures, okay, fine. If successful, and there is always a pattern. If you have done all the questions in your study material, it's all good chance that you will be able to do your question. It happens to be a futures question in your exam. Okay, so if successful, this will be the first time that Nitrogen Limited has exported goods into the highly competitive German market. So you can see that question wording is almost same. The following 3 alternatives are being considered for managing the transaction risk before the order is finalized. So here the order is 4 million euros you're going to get. You are a UK-based company and you're interested to get pounds. The order is in euros and the credit period is 6 months. So invoice the German firm in sterling using the current exchange rate to calculate the amount. So in the last question, it was average. Here it says take the current exchange rate. Okay. That means you're going to take a bit rate. Alternative of invoicing the German firm in euros and using a forward foreign exchange contract to hedge the transaction risk. The third one would be to go for futures. Invoice the German first in euros and use sufficient 6 months sterling futures contract to the nearly whole number and hedge the transaction risk. So the first option was to do it by raising the invoice in sterlings rather than raising your invoice in euros. So that means the risk is shifted to the German company. Okay. So the UK company doesn't take the risk in terms of the currency exchange rate. So it doesn't move in their favor. So they will not be worried about. So here they want that they should not take any exposure. So they should actually raise the German firm in pounds. So here the exposure shifts to the German company and from the UK company. Okay, so that is the advantage of actually invoicing your customer in your home currency. Okay, so if you have not understood, so please refer to my earlier video. So where I have explained that. Maybe the second day or third day I've covered this. Alternate. Then invoicing using a forward exchange rate. So that's pretty simple. And then finally, using it through a 6 months futures contract. So now the rates are given to you. The spot rate is given. It is in terms of euros. So that means 1 pound is equal to so many euros. So but you are going to receive euros. So you should have a euro quote, but the quote is given in terms of pounds. So either convert them. Okay. So let's see. 6 months forward rate is 55 and 0.60. Now here, the quotes are not in decreasing order. So that means pound is appreciating against the pound in the forward market. So here you won't be minusing it. You have to simply add up. So that's the difference between the last question and this question. 6 month future contract is currently trading at 1 pound is equal to so many euros, and 6 months future contract size is again 62,500 pounds, and the spot rate and 6 month future rate is same. Normally it is same, so it is euro is 1.1785 per euro. In India, it is the RBI reference rate we take. This is in the market, in the London market, the rate is given, okay, as per their prevailing spot rates at the expiry of the contract. So in your opinion, which alternate would you consider to be the most appropriate and the reason thereof? So invoice the German firm in sterling using the current exchange rate to calculate the invoice amount. So first is they are using the current exchange rate. So invoicing in Germany in sterling, invoice in pounds, okay, So that means you have the spot rate here. So the rate would be, the rate is in terms of £1 is equal to so many things. So you need to convert in euros. So €1 will be so many pounds. Okay. So you get this rate. Okay. So now you can just simply multiply the bid rate into the euros. So there are 40 lakh euros or 4 million euros. So you multiply it with the bid rate. So you get these many pounds. So 33,98,471 pounds. And in last case, you got how much? So this is basically, sorry, this is the first case. So you got 33,98,471 when you raised your invoice in pounds. So this is, you're going to raise your invoice in pounds to the foreign customer. So he's going to give you money in pounds. So there is no risk on your shoulders. Okay. The risk will shift to the German company. So the following data is available, which is, the spot rate is given to you, which is, per pound. Fine. So £1 is equal to so many rate. This is the spot rate, and 6 months forward premium is given. Okay. So we simply calculate what is the rate of per pound. Okay, by adding the swap points to the both sides of the rate, bid and ask. So we get this rate. So £1 will be equal to 1.1805 bid rate, and ask will be 1.18. So this is pound rate, but we need euro rate. So what we are going to do, we are going to convert that into euro. So we know that it is, bid rate is 1.1700 plus 0.60. If you go back and check, so look at the bid rate. This was basically the ask rate. So it will become a bid rate here because we are going to convert that. Okay. So £1 will be this. So that means euro will be, will become, this bid rate will become, this ask rate will become bid rate. So £1 divided by 1.80. So now we have this rate. That means €1 is equal to 0.8453. So using the forward rate, we got this much of money. 33,81,234. So just to go back again, if we have missed out something. So these were the rates which are given to you. This is the spot rate. Okay. And 6 months forward premium is also given. So you're just going to simply add because, the points are increasing. So that means pound is trading at premium. So if you look at the pound in the forward market, it's going up from the current spot rate. So pound is trading at a premium. So £1 is equal to 1.805 oblique 1.1830. Okay. So the first one is the bid rate, and the second one, so if you look at, this is the bid rate and this is the ask rate. Now you're going to get the money from abroad, so you're going to get in the bid rate. So 1 divided by 1.830 will become your bid rate. Okay. So 1 divided by 1.830 will become your bid rate. So you are going to convert that in terms of pounds per euro, and going to simply, use this forward rate to calculate your money which you're going to get. Okay. So you get 33,81,234 pounds. Okay. So this is now, when you're using the first option invoicing, you're getting 33,98,000. Now you're getting 33,81,000. So far, the invoicing seems to be better from the forward rate. But let's look at the currency futures rates. 6 months futures. 6 month future contract is currently trading at £1 is equal to so many euros. So this is the rate which is the future is trading at in the London market. 6 month future contract size is how much? 62,500 pounds. So the spot rate for 6 months future is given to you, which is 1.1785, which is given to you in the question. So this is the spot rate. Okay. And 6 months future rate is 1.17. So what we do is that we know that if you look at the 6 months future rate contract, because you will go to the 6 months future window where the rate is 1.1760. So that rate becomes relevant for calculating how many contracts you have to take position. So look at the first box. So this rate becomes very relevant for actually knowing how many contracts he has to take. So this is the spot rate and 6 months future rate. Okay. So this is the 6 months the spot rate. Okay. Right. So that means here your €1 will be equal to 0.85034. So in terms of pound per euro, the rate will be this. So 40,000 or 40 lakh euros or 4 million euros divided by the pound So that means your exposure, total exposure would be 34 lakh 1,360. Now, if you divide this by number of contacts, so you'll get 54.42 contacts. But you can't take position in decimals or in this thing. You have to take in whole numbers only. So you will be taking position at 54. So that means you will be not fully hedged, but almost hedged to a greater level. So thus, the euro amount hedged by the future contract will be 54 into the size of the contract. So that means you're going to cover yourself for 30 lakh, 33,000, 75,000 pounds. But your exposure was 34 lakhs, 1,000, which is coming here. So this is your exposure, but you're covering only for 30. So you're short, hedging not to the full extent, but you are under hedged. Okay. Normally you take when you are an exporter, the currency, the foreign currency is euro. Okay. So you are actually long in the real terms because you're going to get euros from abroad, but you take a short position in euros. Remember that always. But here, taking you take a long position in euros, but here the quote is indirect. So you have to take a short position in pounds. So normally you take a short position in euros as an exporter, but since the quotes are indirect, he has to take a long position in pounds. So which is giving you equivalent result. Okay. So buy futures, that means you take a long futures, long position in pounds. Okay. So you bought futures. Okay. So you bought futures, that means you bought a right to buy $1 at 1.76 per euro. So somebody has sold you that right and you have bought it. So you went to the market, stock exchange, and punched your order, placed your order, and the order will get executed. So that means you now have a right to buy £1 at 1.760. The other guy has a right to sell to you. Okay, fine. So now somebody is going to make money, somebody is going to lose money. Either you going to make money or the other guy who has accepted your bet is going to make money. So here let's see who makes money. So close futures at £1 is going to be 1.1785. Now you are the winner because you have bought the futures at 1.760. Okay. And at the expiry, what happens? The pound has gone up. Okay, sorry, the pound has gone up. Now, pound has gone up, so you are making money in the stock exchange. Okay, fine. So, how much money are making on a stock exchange? You minus the two numbers. So, you took a position, you bought futures. That means the future is a derivative contract where you get right to buy the currency at a rate which is you have chosen. So, that means $1 is equal to euro 1.7. So this is the right that you have actually bought futures at this price. So before the expiry, you have an option to exercise your right. You can close your position before expiry or at the expiry. So you're going to get at 1.760. So now, since you have bought it, you will wait for the close of the futures. So usually the futures close on a monthly basis in India. So here it is closing, after maybe a couple of months or 6 months, that is written. So the pound will close at 1.1785. So since you took a long position, you are bullish on pounds, and it happened to be true that your bullishness actually, came true and the pound moved up. So since pound has moved up to 1.1785, so, everything is cash settled in the futures market. So you will just get the difference. Okay. So there is no physical settlement which is taken in the futures market, and all the futures are settled, particularly the currency futures, they are settled in the cash, this thing. Only in stock, we have delivery plus the cash, this thing, so that is only in individual stocks. Okay. And in basically Nifty and Sensex, we have the cash basis, cash settlement. So here, coming back to this example, so there will be a cash settlement. So that means you're making a profit of 0.0025 pound per, 0.0025 euro per pound. So how much is your total profit on the futures contract? 54 is the total number of contracts you have taken. Per size of the contract is 62,500 multiplied with the profit which you have made. So it will give you a profit of, in terms of euros. Okay. So you would be interested no more in pound sums. So we're going to convert that also later on. Amount received after 6 months. So after 6 months, you are going to get 40 lakh euros from your customer. Okay. He's going to send this money to your account. And similarly, the stock exchange is also going to credit 8,438 euros, but your bank is going to convert them into your local currency and give your money a credit in terms of pounds. So the rate was 1.178, which is the currency futures, and the spot rate was same. So we are using the same rate. Okay. So if you use the rate, then he's going to get 34,01,305 pounds. So which means if you look at all the proposals, then the first proposal was giving him, which was, invoicing in the home currency, which gives him 33,98,471. And the forward proposal was giving him 33,81,234 when he used the forward rate. And when he went to the stock exchange and used futures market, then he was getting 34,01,305. So if you look at all the proposal, the future proposal seems to be the best one. So you should go for the proposal number C, and you should go for this proposal. Now, it takes time basically to understand the futures market. So I hope you people are certainly no query. Devraj. Okay, so are you understanding? So I just want to have your view, and we will have a short break after some time. Okay, maybe I'll do one more question, or we will do the next question after the break. Have you followed the questions? Okay, so what I'll do is that I will do some, MCQs before the break. Okay, so just see that you have followed everything. Okay, so we will do some more questions after the break. So we move on to the MCQ section now. So let's work. Okay, in which currency we have to trade in future? Okay, so anyway, I'll answer your question, Namrata, so don't worry. First, let's focus on the MCQ. Using futures contract to transfer price risk is called. So please look at this, MCQs. This will help you to get your reply. Namrata, somewhere in MCQ, you will find the reply is hidden. Okay. So using futures contract to transfer price risk is called diversifying, arbitrage, speculating, hedging. So please give an answer. So answer is D. Absolutely right, Satish. Now, hedging risk for a long position is accomplished by taking another long position, taking a short position, taking an additional long position and short position in equal amounts, taking a neutral position, none of the above. So when you have to take a long position, how you accomplish, there's a long position, what kind of a position you should take in the market, taking another long position, taking a short position. So as I told you, to just take a opposite position. Okay, absolutely right. Shruti Juneja, you're right. Viraj, this question number 2 is E. None of the above. So sorry, Viraj, that's the wrong answer. So D was the right answer. So everyone has done. So here the answer would be taking a short position. So if you are long, you have to take a short position. For example, if you're taking if you are long in dollars, that means you are an exporter. You're going to get money from abroad. So you take a short position in your in the futures market. Okay, to get the benefit. Okay. So now third, hedging risk for a short position is accomplished by taking a long position, taking another short position. Okay. So all this thing the same. So here basically the answer is stereotype. So you will be taking a long position. Question number 4. So question number 2 be short position 7. Okay. So let's come to the question number 4. So just stop worrying about the 3. So let's take about the question number 4 was taking a long position. Okay. 3 was long position. Now we come to the 4th question. Okay. A contract that requires the investor to buy securities in future date is called a short contract, long contract, hedge, cross. So please answer this. So it is contract that requires investors to buy futures. Okay. This is third one was A. Yeah, you're right. 4th one. Third one was A. Wonderful. Mansha, you also got it right. A contract that requires an investor to buy securities on a futures date is called a short contract, long contract, hedge, or cross. So I'm just waiting for your replies. So 4. Okay. So it is basically the fourth one is B, which is taking a long contract. So Devraj, you have many messages. So I have not seen any kind of things. I'll just see what questions you have asked. So you said good morning. That's absolutely. Then you said yes, Sarji. Then we take we have to sell or purchase future contract in home currency. So that is one. And then there was a question. Devraj, Sarji has sent many messages. Okay, so I'll answer your question after the break. Okay, just wait for some time. Now, fifth question. Hedging in future market eliminates. Now, this is a very important question. So please focus. Hedging in the futures market. So they will just live for some more time. As I told you, all the questions are similar in nature. So if you have missed out one, you will be your answer is getting covered in the next question. So hedging in the futures market eliminates the opportunity for gains, eliminates the opportunity for losses, increases the earning potential of the portfolio, does all the above, does both A and B of the above. So this is a good question. If you are able to answer this, that means you have understood the futures market. So please answer the fifth question. So I'm just waiting for your responses. So Devraj, don't worry at all. I'm going to answer your question. Okay. Viraj, the fifth ka B. Fifth ka E is the answer. E is the answer. Okay. So hedging in futures market, you said B, eliminates the opportunity for losses. You don't even get any gains in the future market if there is no way you can make money. Okay, only in options you can have an advantage of gaining. Okay, but in the futures, it is neither you make a loss nor you make a gain. Fine. So if you remember my video yesterday, you will follow. Yeah, Satish, you're right. So how is also? How A also? No, A is okay. That is one part of the story. Okay. So Mansha said B and C. B and C. No, I know that most of you will get answer wrong. So basically, if you are taking a futures position, okay, so that means you're not going to get either any gain or any loss. So you will be hedged completely at the rate which you have chosen. If the rate goes up, as an importer, you're not going to incur any loss. But if the rate goes down, you're not going to get the benefit. If it goes in your favor, it is not going to benefit you at all. Only in the case of an option, you can get the benefit. But in the futures, it's a linear product, which actually basically eliminates the opportunity of any gain. So you don't get any gains, neither losses. You're completely hedged. So whatever happens, you get the same money at which you have taken the position. So answer is B. Okay. So no loss means more earning. Okay. Fine. So let's talk about sixth. Okay. So I think which of the following does the most to reduce the default risk for the futures contract? So this I covered this in the first slide when I was talking about the difference between the futures and options. If you are there, you will be able to answer. Question 5 is not clear. So Namrata, just wait. I'm going to answer that question after the break. Okay. And of course, the question is coming up. There's an MCQ which is coming up. Next one, which will answer your question. Okay. Which of the following does the most to reduce the default risk? Mark-to-market settlement, high liquidity, credit checks of both buyers and sellers, flexible delivery arrangements. So here, the answer is A. Absolutely right, Satish Kumar. The mark-to-market settlement, which means daily settlement. So in stock exchange, every day the settlement is happening. If you're making money, you will get money. If you're losing money, the money will go out of account. So that means if it is every day happening, so there is no risk at all in the trade, and the trade will get fully, executed, and there will be no default chance of any risk to both buyer or seller. Okay. Now this is the question. Okay, Namrata. So you asked file is not clear. Okay, fine. So look at this question. Amul Limited purchases coca to make its product. So please focus. This is a very important one. The company is concerned that the prices may rise prior to piling of inventory. The company is concerned that the prices may rise prior to piling inventory for Diwali sales. Now, Diwali is approaching, so Amul wants to buy coca. So he knows that generally the coca prices go up, when the Diwali is around the corner. So people are, piling up inventory for coca. It is forecasted that the price per ton would vary from $1,250 to $1,500. Okay, so the forecast is that it may be anywhere between 1,250 to 1,500. October futures contract can be obtained at 1,300 purchase price. So he says that the future contract can be obtained from $1,300. So what is the Amul risk in this situation? Coca price will rise above 1,300 and Amul will purchase its coca price at 1,300. Is that the risk? Coca prices will decline below 1,300 and Amul have to purchase the coca at 1,300. Coca price will hit 1,300 and the contract will was a waste of time. So it says that, it will anyway be 1,300. So why have you gone and taken a futures position? Because that is the price which is going to be hitting at. Amul has no risk of this situation. Sir, you are very hard working and best teaching. Thank you very much, Devraj. And, I'll answer your questions. So don't worry about that. And in case if you have any issues, you can always, approach me to the Institute of Chartered Accountants. So don't worry about it. So answer this question. So 10B. So answer is B. Absolutely right, Satish. Now here is your answer, Namrata. Okay, or who asked it? Yeah, somebody asked me, this question. Okay, no loss. Manisha, no loss means no earning. Yeah. So there was one question which I was thinking about answering. So I'm just looking for that question here. Okay. So B. So basically, here, when you have booked your contract in the futures market at 1,300, fine. So what will happen? You are going to get your, this is your hedging rate. So whatever happens, whether the coca price goes up or down, you are ensured that you will be getting your coca at 1,300. If it goes up, you're happy, man, that you have made a futures contract at 1,300. So that is the rate that you have to pay. But if it falls below, it goes to $1,000, then you're not going to get benefit because you have to purchase, since you have entered into a forward contract or future contract with someone to buy the coca at 1,300. So even if the rate goes to 1,000, he's not going to sell you at 1,000. He's going to sell you at 1,300. Okay. So coca price will decline below 1,300 and Amul will have to purchase at 1,300. And Amul coca prices will decline, but Amul has to purchase. Okay. So it is an obligation process. So this is the answer. You're looking for Namrata. So when you enter into a forward contract or futures contract with someone, you decide the rate and fix that. Okay. In forward contract, you say this is going to be my rate. So supplier is going to sell you that at that rate. In the futures also, you're taking almost a similar call. So you are going to get 1,300. Even if it falls below, you're not going to get that advantage. Okay. So you don't have any option. In option contract, you have an option. If it falls below 1,300, then you will not, go for buying at 1,300 from where you have purchased. So you can decline. You can say, okay, I'm not going to exercise my option to buy at 1,300. I am going to buy at, say, $1,000, which is a current rate. So that is permissible only in the options trade. And in futures trade, you can't take the benefit if the currency goes in your favor. But if it goes against your favor, then of course you get the benefit, because if the coca rises to 1,500, you're still getting your coca at 1,300. But if it goes to 1,000, you're not going to get the advantage. So I hope, okay, sir. Okay, now you have understood. So good. So this is, so that is all. And we are going to have a break now. Okay. So it is 8:19. So after 15 minutes, we'll break. So we'll, come back. Okay. Okay, so we are back again, and I just shared the PPT. So this is the last question on futures, so which I'm going to solve on a board. Okay, so that you understand it, this thing. So first, let's go through the question since I think the assignment you have not received. The question is EFD Limited. EFD Limited is an export business house. Okay, the company prepares an invoice in customer's currency. Its debtors of US dollars are 10 crores, which is due on 1st of April 2015. Okay, so they're going to receive money of 10 crore US dollars when on 1st of April 2015. Now, this is the market information which is given to you, as of January 1st, 2015. So the spot rate is given, the 1 month forward, 3 month forward, initial margin is given, 3 months margin is given, rate of interest is given, contract size is given. Almost a similar question. So, we find about, a lot of questions which have come in your CA final, which are in similarly, which are actually given in indirect code. Okay. So let's first read the question, and then I'm going to put you on the blackboard. Okay. So on 1st April 2015, the spot rate is USD INR is 0.016136. So this is the rate, the spot rate, and currency future rate is 0.016134. So this is the rate at expiry. Okay. And the spot rate published by, say, RBI. Okay. Which of the following methods would be the most advantageous to this company? Using forward contract, using currency futures, and using not hedging. Okay. So let's start to solve this question on the board. So I'll just, share the screen. I hope my board is visible to you. Okay. So I'm just opening up the question to look at the question. So I will be just writing the question also so that you understand. So the first one is, so we have, there is, how much exposure you have. Let's write down that exposure. So this is US dollars. Okay. How much you have to receive? 1, 0, 0, 0, 0, and 3 zeros. So this is the total amount the company is going to receive. Okay, fine. Let me see whether it's importer or exporter using ASIC. So the question says, I'm just reading out the question loudly for you. This is a company which is an export business. The company prepares the customer's invoice, so it is debtor and like which is due on. So this money which is going to get on due on 1st April 2015. This is the due date on which the money is going to receive. Okay, fine. So today the date is January 1, 2015. Okay. So now he gets the following information. So he's going to, get the money. So it is January today. So that means, January, February, and March. So on 1st April he's going to receive. So this is going to receive after 3 months. Okay. So that means we are worried about what is the forward rate. So we will be looking at the forward rate. Okay. Which is given in the question, which is a 3 months forward rate. Okay. So we are going to use that, which is given as 0.016129. Okay. So this is the 3 months forward rate. Then this is the information with regard to the forward market. Okay. Now we come to the futures market. stock exchange. There, it is given that the contract size is how much? 2,4. Now, this is in rupees. Okay. 24816. So 2 crore 48 lakhs 16,975. So this is the contract size. Okay. 2 crore 48 lakh 16,900. This is the contract size. Now we are going to get the money in the month of March. So the April rates will become the month of March window will be very important for us. So the rates are given for futures for 1st of April. Okay. Fine. So this is the rate which is given to you. Rather, it is not given the date here. So they are just given the contract, the price. Okay. So a 3-month future rate is given. Okay, which is 0.016118. So this is a 3-month contract which is today, available at 1 rupee is equal to so many dollars. So this is the rate which you find in the futures market. Then apart from that, some information is given regarding margin. So initial margin. So here the initial margin is basically for 3 months. It is written as, so we will use the 3-month option, okay, which is rupees 22,500, and the rate of interest which is given as 7%. Okay, so 7% is the rate of interest. Right. So this information is given, and with this, we need to now there is some additional information which is given, which is on 1st April. 1st April 2015. Okay, the spot rate is given to you, which is given as USD INR as 0.16136. So this is the spot rate. Okay, right? And the future rate is also given to you. Okay, so future rate is also given to you. Normally they're normally the same, okay, but there can be some minor differences. It all depends when you're closing your futures. Okay, when the futures are closed, before the expiry, then the future rate becomes applicable for settlement. Okay, 0.16. Otherwise, when you're closing your position at the expiry, then the spot rate becomes relevant. Okay, so the future rate is 0.16134, and the spot rate is on that date is 0.16136. So this is the RBI. This is the rate which is spot rate available, and this is the future rate. So maybe that you are closing your position before the expiry. So now, first option would be we will be using the first option, which is forward contract. So now he is going to get how much? US dollar 1 crore. Okay. So there are 3 zeros. So this is the amount he is going to get. Okay. 325. Yeah. So this is the amount. So we are going to divide this by the forward rate, which is this one. So 0.016129. So which means he is going to get rupees 62 crore. Okay. 1240. So that means he is going to get. So I'm just going to write it again. So it could be 620001 124. Okay. I put one. So this is the amount he's going to do. Okay. 62001024. So which means he's going to get, or 140 is also there. Okay. So he's going to get this. So he's going to get, 62 lakhs, 1,240. So this is the amount he's going to get if he uses the forward contract. Now, let's go and check how he's going to use the futures, currency futures. Okay. So second is futures. I hope you're able to see the board properly. Okay. So here we know that the total, exposure is 10 lakhs, 1 crore US dollars. So if we divide this by, the contract size, which is 0.06118, so you'll be using this rate, the futures rate, okay, which is this. 3-month future was selling at 0.006. So we are going to divide that. This is the stock exchange rate. So we know to calculate how many contracts he is going to, go for. And then we are going to, whatever question we get, answer we get, we're going to divide this by 2 crore 48 lakhs 16,000, which is the contract size, which is this. Okay. So this is US dollars. This we are converting them into rupee at the rate at which you have taken a bet. Okay. So you divide that. So it will get, in terms of rupees. So you have to actually use the future rate in which you are going to take your position. The rate is 0.1168. So you convert that into rupees and divide by the lot size. The lot size is 2 crore 48 lakh, which is given the question. So you will get 25 lots. So here I am writing 25 lots. So you have to take position in exactly. So the figure comes in round whole number. So I'm just rubbing this off. Okay. So he has to pay a margin, initial margin. Just confirm whether you are able to see on the board. So now I understand. Okay. So initial margin, which is 25 contracts, okay, multiplied by the margin, which is 22,500, which we have written somewhere here, okay, which is the margin we have written here somewhere. I'm just searching for that margin here. So into 22,500. So that means this much amount he has to pay, 5,62,500. Now this money is getting blocked for how many months? For 3 months. Okay, fine. So and we know that. So we have to calculate the interest on that later on. So this is what is given to you. Now you are going to take a long position. On rupee, on INR. So you are an exporter, okay? So you take a short position in dollars, but when the quotes are in direct nature. But if they're indirect, so you're going to take just the opposite position. You're going to take a long position in INR, okay? So he's going to actually buy futures, okay? Fine. So he buys futures. That means he buys futures on a future contract. So he's going to buy a future contract. Going to the stock market, he is going to buy a contract. Okay. So he buys a future contract. So he places an order for buying, and somebody accepts it. So if they accept it, the order gets executed. So you have a contract to buy futures at what rate? So at the rate of say 0.016118. Okay. So assuming that you punch this rate on the market and somebody accepted your order at this rate, so this will become the order in which you are going to book your order. Now you are going to sell your futures or close your futures when you want to book your profit. Okay, so you want to close. So On the date of closure, you will look at the rate. The rate is given to you, somewhere here. On April, the spot rate. The future rate is how much? 0.1634. So that means you're going to close at this 0.016134. So this you have closed at this. So which means, so he's making a profit. So you bought, so you were long on INR and INR appreciated. So that means you're making money in your bet on INR. So you take a long position, you bought it. So you bought from someone at 0.1618. So you get a right to buy. Now the price has gone up to 0.01634. Okay. So no delivery happens in the stock exchange. The other guy is going to give you difference. So since you are in a winning position, so he's going to give you the difference between these two rates. Okay. So how much you get? Basically, it will be, $0.00016. Okay, 16. So that's the difference between the two. If you get 34 minus 18, you get 16. Okay, fine. So this is the profit per rupee. Okay. So you want to know what is the total profit in dollars and then convert it into rupees. Okay. So how many contracts you have? 25. So you are going to multiply by 25. And what is the size of contract? 2 crore 48 lakhs 16,975. Okay. So which means if you multiply this, you will get your answer in dollar. So it will be dollar 9926.79. Okay. So this is what you are getting. Fine. Now this is in dollars. Now this is written that the spot rate is how much? 0.1613 at the expiry. So you're going to divide this by expiry price, which is going to be the spot rate. This is 0.16136. So this is what you're going to do. Okay. So it is actually you have to add 1 0 here. Fine. So here maybe it is 0.0. So this is the answer. Let me just check. Yes. So this has to be here 0 here. Okay. So I'm just going to put it out. Okay. So here I missed out. So let's go back. So now we have to convert this money. So this comes to, rupees, how much? 6,15,195. So that means this much of money he has made in the futures market. So in the futures market, he has made a good profit, which is 6,15,195. Okay. Now, his margin will get released, okay, because the contract is over, he has got the profit. So the interest cost on this, you have to calculate, which is going to be at the rate of 7% for 3 months. Okay, which is going to be rupees 9,843. So here, 5,62,000 into 7%, 3 divided by 12, so you get rupees 9,843. So I'm going to write it clearly. Into 3 by 12, so we get 9,000. So this is in rupees, 9,843. So this is going to be his cost. Okay, fine. So now on 1st April, he is going to get $10 lakh from his customer. And suppose he gets, rupees, he's going to get $10 lakh. So I'm going to write that. So on 1st of April, he is going to get this much of money. How much? So these many dollars he is going to get. Okay. Fine. So what is the rate, at which he is going to get money? He is going to get, the spot rate is given as, which is there somewhere. Let's just search spot rate, 0.001636. 0.016136. Okay. So this would be basically, if you get, so it comes to 61. So this is in rupees. Okay. 6197 32 276. Okay. So this money he gets. Now he gets a profit of this. How much money he has made in the stock exchange, which is given somewhere here, which was let me search. So he gets a profit of he gets a profit of 6. This one. So 61519 minus 9843. Okay. So this money the banker will give him, this money the stock exchange will give him, and this is the interest cost. Okay. So net result would be that he is getting 6203 37 627. So this is the forward option, the future option. Okay, fine. So forward contract he was getting this, and future is getting this. So when we compare, so the forward is giving more. So now we go to the no hedge situation. Okay, I'm just going to rub this off. It's a pretty long question that we do in a board. Even a long board will not be sufficient to complete it. So I try to just squeeze in all the information. So let's talk about the forward contract first. In the forward contract, he got rupees this. In futures contract, he got rupees this. I'm just going to write a figure. And no hedge. So we have to calculate no hedge. He's going to see. And then we find which is the better one. So here he gets 62 lakhs 001. It's 000 124. Okay. I'm just going to write it again. So 62, okay, 000 1240. Okay, fine. So if you put the commas in the right place, so you get 62 lakhs this much. In the futures market, he was getting 62 lakhs again, not 63. 6203 06237 and 627. Okay. And in no hedge situation, he's going to get, first let's talk about dollars. The dollars 1000000 divided by the spot rate on the close of the period, which is, the 1st April. Okay. So 1st April, the spot rate is given as 0.01636. So this will be basically 60 rupees, 61 lakh 97,000 32,000 and 276. So which option is better? The option number that you should go for, the futures contract. Okay. So let me get to the screen now. I'm just going to show you on my slides also. So hurriedly, I'm just going to take you through the slides. Okay. So able to see the board, yeah. Okay, we are this side. You have a question. Okay. So first of all, we just stop where this comes, and I'll explain. So this is receipt using the forward contract. So we are taking a 3 months forward contract and solving it. The number of contracts needed. Now, this is the place. Okay. So 0.0016. No. So number of contracts would be 10 lakh. This so many dollars divided by 0.016 divided by the rupees. So you get number of contracts. So margin will be paid for 25 contracts. So margin will be 5,62,500. Normally, you take a short position in dollars when you are exporter, but here, since the quotes are indirect, so you'll be taking a long position in INR. So he takes a long position at, he buys at dollars at he buys rupees per dollar at 0.01168. So at the close, it was 0.06134. Okay, so he makes a difference. Okay, so he makes a difference of this. So that is 0.016. Now let's just calculate that. Let me just use the calculator. So it is 0.01, sorry, 0.01613 minus 0.01618. So if you calculate that, it will come to 0.00040 and then 16. So you get 4 zeros and 16. So the calculation is absolutely right. Okay. So this is per rupee. So that means he's making this much of gain per rupee per contract. Okay. So now the profit is into there are 25 contracts, and each contract is valued at 2 crore 48 lakhs. So if when you multiply it all, the number will be in dollars because your profit is in dollars. So you're multiplying by the contract size. So you have 9,926, dollars. Okay. So it is not like 99,267, but it is 9926. Okay. So then the gain will be, so let me just check the calculation. Okay. So let me see if you have some point to make. So let me just check calculator. So it is 0.0001. Sorry, I think one more 0.016. Okay, fine. Into 25 into 248 16975. So we make a profit of $9,926.79. So my calculation is showing 9926.79. So but you're showing 99,267. So please correct yourself. Okay. So it is 99. Profit is 9926. Okay. Okay. So now we are going to convert this at the spot rate. Now you're not going to get dollars. Okay. Suppose you're trading in India. So you're going to, and you're more interested to know how much Indian rupees you're getting. So you're going to use the spot rate. Okay. You're going to go to the bank and say, or the bank is going to convert that for you at 9926. This money you're going to get from the stock exchange. So they're going to give you in rupees. Okay. Fine. So at the spot rate, so it will come to 6,15,000. So margin will be released. Okay. So interest cost on the margin is for 7% would be 9,843. So exporter will get 10 lakh from his customer. So banker is going to, credit his account at the spot rate. How much? 61 lakh 97,000, 61 crore 97 lakh 32,000. So the net receipt will be that though he's getting at one end the money from the banker, okay, at the spot rate, and then he's going to get, a profit of 6,15,000 which he has made on the stock exchange, and minus the margin which he has, the money which was blocked, so 9x, so he's getting this. So which means this is the three rates to you. Okay. So that answers the question. So that means the most advantage would be to have a hedge. Okay. I hope you have followed, please. So kindly let me know you have understood, and how is the lecture so far? Was it useful? Are you finding easy to understand? Because we have done almost so many questions of similar type. So I would like to have your comments on the chat box before we move on to the final one, which is options. Okay, so now I'm going to move to the options. So options we are going to do, so which is the most difficult part, the most difficult part of the journey. So many people get confused with the options. So listen to me carefully, and you will find that it's also very easy. Now we are going to talk of currency options. So the topic which we are waiting for, and the most dicey, tricky topic. Okay, and let's understand what is currency options. Now let's understand this through an example straight away, without understanding, because you have done your options in your stock market or in your stock chapter, derivative chapter. So we are going to skip the theory part, but I'm going to cover wherever it is required. So example of hedging using options. All the some part of the theory, lot size, everything remains the same as it was in the futures. Okay, but XYZ is an importer. So on 30th of January 2024, X Limited. Now, are you getting the screen on your board? Please confirm, though I have shared it. So on 30th of January 2024, XYZ, okay, Limited wished to book its outward remittance for 27th February 24 worth $1 lakh. So on 30th of January, suppose assume that today is 30th of January, and there is a company called XYZ. They want to, they are importers, so they are going to pay some money on 27th of February 2024. How much is the money? $1 lakh. So they can, go to forward market. They can go to, other means. Though now they are choosing to go to the future and options market, and they are choosing options over the futures. Okay. So here, the most important part is that you will find various strike prices available, not visible. Let me see. Okay, yeah, I'm just going. Sorry, I don't know how it happened. Okay. So now is it visible? Please confirm. Please confirm the screen, because this is the most important part. So now confirm, because I've shown it. Okay. Let me just check. I'm just waiting for your response, please. Okay. I can see the screen is now visible. Okay. So let's start. I've also opened my lecture. So I'm just going to put the, everything in order so that you can listen to me. Okay. So let me see your response. What is the one? Now visible. Okay. So this is the most important part. So just please focus. Okay. So example on hedging using currency option. So XYZ is an importer. Okay, fine. So, on 30th of January, 2024, assume that today is 30th of January. Okay, so it happened on 30th of January when I made this slide. So XYZ Limited wishes to book its outward remittance for 27th of February, 2024 worth $1 lakh. So that means this guy is an importer. He has to pay $1 lakh when on 27th of February. And today date is 30th of January. So he goes to the options market. He goes to future options stock exchange, and he finds that he has to choose a strike price here. Okay, he has to choose a strike. So there's a new concept. So he has to choose a strike price. Now he will get a lot of strike prices available to him. He has to choose one of them. Okay, I'll tell you how to choose that. So he chooses 83.25. Now look at the bottom of the screen. What is the spot price on 30th January? 83.15. Normally, whosoever is taking a hedging position, he will choose a price which will be very close to the spot price. Now, this was the closest to the spot price. Okay, so he choose this strike price. Now he has to pay a premium. Okay, so you are a option buyer. There is somebody who's called option seller. He's going to charge you a premium. Okay, like you can become either an option buyer or seller. You can even become an option seller and charge premium. Okay, but in this case, you're an option buyer. So you're going to choose a strike price and pay a premium to the option writer. Now, the premium is 0.185 per dollar. So this contract is going to expire on the month of 27th of February. So there you will find there are a lot of contracts available in the options market. Okay, and you have to choose the February month. Okay, in the stock market, there are three contracts which are available: the near month, mid month, and the far month. So this is basically the 27th February 2024 month. So number of contract, how many? Again, 100 contract because the lot size is same. Okay. Now, the most important part, he is going to buy a call option. Now, there are two kinds of option, call option or a put option. A call option when you're bullish. Okay. When you're bullish on something, you buy a call option and you make money if that asset goes up. So here you are bullish on dollar. Okay. So you think the dollar price will go up. Now, as an importer, you don't want that to happen because you have to pay more money, when the money has to pay through the bank on the day when the money falls due, but you're hedging yourself. Okay. So because you're going to make money in the stock exchange if the dollar goes up. So that profit will get offset against any losses which you'll be making at the time when you make the payment at the time due date to your customer. So, or your supplier. Now, the option premium which you need to pay, so you buy a call option. That means you buy an option. Call option would be, it will give you a right, but no obligation to buy the dollar at 83.25. So here you get a right, but no obligation. If you don't want to buy, you can, not exercise your right. Okay. Otherwise, if you want, you will exercise the right. So I'll explain that whole thing. So in a short period of time. So option premium would be, $1 lakh you have to pay multiplied by 0.185. So you're going to pay an option premium. Now, the option contracts are just like, insurance covers. So when you book your, house or a car and take insurance of your car, you have to pay insurance money to the company. Okay. So if there is a loss to you, the company is going to bear. Otherwise, if there is no loss, the insurance company their profit will be the premium which they have collected. So an insurance company collects lots of premium, but there are very few people who lodge a claim for if there is a loss of car or there's a damage. So only that case you're going to lodge a claim and you're going to get the money. So the amount of money which you can claim can be almost equivalent to the amount of car. If the whole car is lost, or there is a theft or stolen case, or if the whole car is damaged, the company is going to give you the total price. So there is unlimited potential of making a loss for the option writer, who is the insurance company. So they're charging only 18,500, but they're giving you, full this thing. Like, when you book when you take an insurance of a car, so they're charging only, not the full price of the car, they're charging some premium, and, they give you a insurance this thing. So here also, the option premium is collected by the option writer. So this is only going to be his income. Okay, he can lose a lot of money if suppose that there is a claim. So it's like that. Okay. Otherwise, he's going to pocket the premium if there is no claim loss to him. So similarly, buy a call option, that means you buy a call option. Okay. So you have a right to exercise your call. If you don't exercise, then the option premium will be the total profit of the person who has sold the option to you, and the person who sells the options to you is called the option writer. Okay. In the stock market, you can become any. You can become a call buyer or a call writer. That is your choice. Okay. So you place the order, and it is like this. Suppose you bought a ticket for going to a movie next month. Okay. And you paid 500 rupees for the ticket. Now you get a right to go and watch the movie, but there is no obligation that you have to go and watch the movie on that day. If you don't go, nobody is going to call you up. The theater people are not going to call you up and say why you're not turned up. So the only loss will be your premium. So here, if you don't exercise your right, the only maximum you can lose is your premium. Okay. So if you think that everything is moving in your direction, you are going to exercise. So let's understand that. So now let's understand what is a strike price. Now, when you go to the stock market, you will find for the expiry date, 27th of February, there are about 16 strike prices which are available. They are starting from 80 rupees and goes down to 86. So you go to the stock market, I may take you to the stock market very shortly. So there is a premium for each strike price. Now for 80 rupees, the premium is 3 rupees 5 paisa. On $1 lakh, it will become 3 lakh 5,000 premium. So it is called in the money. It's a deep in the money call, which is the most expensive one. Why? Because today the spot price is basically let me just go back here. So the spot price is 83.15. Okay. So when the stock price is 83.15, so if you choose a price of 80, that means your profit will start from 80. If the dollar moves to 81, you're making 1 rupees profit. Okay. If it goes to 82, you're making 2 rupees profit, minus the premium, of course. Okay. So you get a good, point. The dollar is today 83. Even if the dollar, falls down, you're still making money. Okay. So because this is an added advantage you get. So that's why it is available at a very hefty premium. Okay. So at 81, if you go down the line, the strike price go down, the premium also falls because you will lose 1 rupee potential of profit. Okay. So the premium will also go down by a certain amount, okay, to 2.225. So these first three calls are in the money, okay, because they are, anything which is close to the spot price will be called CTM, which is close to the money, okay. So there are three calls which are close to money: 82.5, 83, and 83.25. If the call is available at 83.15, it's called at the money, okay. So the at the money call will be the most cheapest one, okay. So here we are choosing 83.25, slightly over the 83.15, which is a spot rate. So you have to pay 18,500 premium. So if you choose, out of the money call, suppose you choose 86 rupees or 5 rupees, then the premium is just 0.005 or 0.0075. So you have to pay only 750. Now, in this case, only if the dollar goes past 85 or 86, you're going to make money. Okay, if you choose 86, your profit will start only after the price goes, the dollar goes by above 86, which the price today is 83. So that means you are not worried about, till 86, because, you think that you can bear the loss up to 86. But if it goes to 90, then it will be a big problem for you. So then you think that 86 is the right price. You pay only 500 as a hedging cost. So it will all depends upon your outlook and this thing, how far you can bear the cost of hedging. This thing. Suppose if the dollar today is 83, it goes to say 86, you're not worried about it. You're only losing 3 rupees. Okay, fine. So you think it's fine. So let me pay just 500. Only when it touches 90, I'm going to get 4 rupees of profit. So let me take a deep out of the money call. I'm not worried about, and I can take some risk on my shoulders. Okay. So now I'm just going to show you the stock exchange, the whole thing. Okay. So let's go to the stock exchange. So this is, where we are. This is the portal. So we go to the currency ones and we go to, place order. Sorry, I don't think you're able to see that. So I'm just going to share with you. Just bear with me. So I need to stop share. Okay. So then I'm going to show you the screen of the stock market. Okay, now I think you can just see the screen. Okay. Fine. So here basically you went to the currency market, you placed the order. Okay. So you saw there is a future window, there is an option window, futures we have already done. So we go for the options. Okay. So we go for the options and then you have to choose the currency pair. So you choose USD, INR. Fine. So you don't have to give them INR. Okay. So you have to choose a call option. So CE option is the call option. So select the contract. So you will find, the contracts available to you. So this is a contract. So please request your process. Please try after 2 seconds. Okay. Now you get, this is the strike price. So this is for 1st of March. So we need basically the 27th of March. Okay. So let's go to 26th March. Okay. So so you choose 26th March. Okay. So what you can do is that you can choose call option all, and you're going to choose the March month. So your payment you're going to receive is say 26th March. So you choose close to this thing. So here you choose this one. So 26th March, the option is available at a strike zone. These are the strike prices. Okay. So I just forgot to tell you. So this is basically, the various strike prices, and this is the premium price. Okay. You can either buy a call option or you can write a call option. And this is and you can choose all in the money. Okay. Or close to the money. Let's say we choose all close to the money. Okay. Because we are going to go for all the close to the money. So that means we will choose say 26th of March when our payment is going to be there. So the spot price is, you can look at the spot price, which is 82.86. Okay. So we'll choose anywhere which is near to the 82.86. So which is, 82.75. Here the premium is 0.24. Okay. So if you choose 83, the premium falls because the dollar price currently is 88. So that means the premium is going to fall. Here, the premium at 83 point going to fall further. Okay. Fine. If you choose a higher price, then the premiums will be higher. Okay. So let me just go back here. So now let me just share the slide with you. So then we go to the slide here. So we are back to our slide. So we are choosing. Now let's go back to our question here. So this is the question. Okay, let me see if you have any queries right now. Okay, so that means you have chosen a strike price in such a way that your hedging cost is not very high and it covers your risk. Okay, if you are very bullish, then you can choose in the money strike price. Otherwise, normally you will go for close to money, which is very close to the spot price. Here, the spot price is 83.15. So you choose very close to that. The premium will be very reasonable. So it will be 18,500. Okay. If you choose out of the money, that means you take some risk on your shoulders and you pay a less premium price. Okay. So you get a right to buy the dollar at 83.25 strike price which you have chosen. Okay. So you have no obligation. That means if you are not interested, you can just walk out of the contract and nobody is going to ask you any question. So, and this is the strike price I told you. Now, let's understand two scenarios. Suppose the month end has come, the date on which the payment needs to be, made. So, 27th of February, case one. Now, what happens? The dollar goes up. The dollar has gone up. It's a good news for you. You've taken a call option, which means if the dollar goes up versus the rupee, you're happy with that. You're going to make money. So you're going to exercise the option. Okay. Or the option will expire in the money. So what you're going to do is you're going to exercise your option. Or in one way, we can say the option expired in the money, because on 27th February is the expiry day when the RBI announces the spot rate, which is 84.50. So since you have chosen a lower rate and the dollar has gone up, so you are making money. Okay, the movie is good, so you're going to watch it. Okay, you're not going to lose the premium. So here, the cash profit you're making is 84.5 minus the strike price, which is 83.25. Okay, so that is 1 rupee 25 paisa. So you make 1,25,000 rupees of gain. Of course, minus the premium which you have given. The writer has got the money, so you have to pay 18,500 upfront. Now, the writer is going to give you back 1,25,000. So that means net gain for you will be 1,06,500. The writer is going to lose money. The person who has sold the option is going to lose money. The person who has got a call option is going to make money. You are the person who has taken a call option, you are going to sit on a profit. Now, since the price of the dollar has gone up, so you're losing on your underlying transaction. So on that day, the banker will say, give us 84,50,000 so that we can remit $1 lakh to your importer. Okay, to the importer. So he has to pay this. So the exporter is going to be paid this money. So what will be the net outflow? It will be 84,50,000 minus 1,06,500. So which means the overall outflow is going to happen is 83,43,000. Which means if you have to calculate what is your hedge cost or what is your hedge position, it is 83,43,500 divided by $1 lakh. So it will come to 83.4350. So this at this rate you are hedged. So what is this rate? The strike price plus the premium cost. So 83.25 plus 0.85. If you add, you will get the same rate, 83.435. So you take the strike price, add the premium. So that will become, if you exercise the call, that will be your, the price at which you are going to hedge your position. Okay. So now the second scenario. Now assume the dollar has gone down. Okay, the dollar has gone down to 81.75. Now, though as an importer, you're a very happy man and you would have not taken a hedge, so you would be paying at a lower price. But since you have taken a hedge and you have bought an option, still you are a happy man because you can just walk out of the contract. So you think that I'm going to pay only 81.75 to my banker for making 1 lakh payment. So I'm not interested in this contract. So he's not going to exercise his right. But he's going to lose the premium. So movie is not good. So you lose the movie ticket price. So here you lose the premium, okay, on taking a bet. So which means the importer now has to pay 81,75,000 rupees on 27th February when the banker will call him and say, now, hey, your payment is due for 1 lakh and today the rate is 81.75. So please pay 81,75,000 into account so that we can, remit 1 lakh to your supplier. So now what will be the actual outflow? The money which is going out of your account plus the premium, because now, so since you have, you didn't exercise your right, the premium becomes your cost. Okay, so he gets the gain on rupee appreciation. So here the advantage is that you are going to get an advantageous position. So if you feel that you are in a winning position, you're going to exercise your right. If you're in losing position, you are going to simply walk out of the contract, only lose the premium and enjoy the benefit of a lower rate as an importer. Okay. So let me just cover as an exporter, then I'm going to sum up everything. So example of hedging using currency options for exporter. So now you are an exporter. Okay. On 30th of January 2024, so assume that today is 30th of January. So we want to book an inward remittance. That means you will be getting $1 lakh when on 26th of March 2024. Okay. So you went to the stock exchange and choose a strike price. Now today's price at the bottom of the screen, you see the spot price is 83.15, which is on 30th of January. Okay. So you choose a price which is very near to the spot price. So you choose 83. Okay, out of the various options which are available, I'll choose the options which are available on the stock exchange. So you have to choose a strike price of 83, for which you pay a premium of 0.1525. This contract is going to expire on 26th of March. So for you, the March contract becomes most important. You will ignore all other contracts and only view the March contract, okay, in the stock exchange. So number of contracts 100. Now you're going to buy a put option. Instead of buying a call option, you're buying a put option. When you are bearish, when you think the dollar is going to go down, okay, which is just the opposite way of when you're an exporter, you want dollar to go up and you're going to make money. But here in the stock exchange, you're just taking the opposite position. You think the dollar will go down. Okay, so you're betting the dollar to go down and make money. So money which you make here will get the offset the losses in the real market. Okay, so on the real underlying transaction. So you buy a put option. So you get a right to sell. The put option will be you get a right. You bought put option to sell dollar at 83 rupees. Okay, so this is the meaning. So you have a 1 month window or a window up to 26th of March to exercise your right to sell the dollar at 83. So you have to first pay a premium of 15,250. Okay, and after paying the premium, so let's see, these are the strike prices which are available. All the out of the money, close to the money, and in the money. So look at the, it starts with the reverse direction there. So the 81 price will be out of the money. Okay, so the premium is only 0.0125. So deep in the money, the premium is 84, where you are paying 0.75 premium, 75,000 rupees of premium. Okay, now today the price is 83. If you choose 81, if the dollar falls below 81, you will start making money because you are choosing a strike price of 81. Okay, the dollar is today at 83. Okay, even if it falls below 81, you are going to make money. Okay, fine. It is going to fall below 81. You are going to make money. It is 83. Okay, so that means it has to fall up to 81 to start making money. So it is out of the money put option. So that means between 83 to 81, you're taking all the risk on your shoulders. Okay. Suppose look at the in the money, 84. So at 84, if you choose, it is the costliest option where you have to pay 75,000. If it falls below 84, you're going to make money. So it's already 83. Okay. So it falls to 83, 82.90. So you're going to make a good money. So 84 is deep in the money and 81 is out of the money, and close to the money is somewhere about 82.5, 82.75, 83. So these are the two close to money. So we choose 83. Okay. Now, what happens? Again, two scenarios. Assuming the rate has come down. So rate has come down, you are what? Exporter. Okay. So you're not happy with that. Okay. Because, you're going to lose money. So you're going to exercise this right because, the dollar has come down. You are betting on dollar and you have actually, bought a call option, put option at 83 rupees. That means if the price goes below, you have sold somebody dollars at 83. Okay. Mind you. Now the price has come to 82. So you're sitting on a profit because you have sold someone at 83 and he has accepted the challenge. The price has come to 82. So you're going to exercise this right. Okay. So now the gain will be 82.05 minus 83, which is the strike price. So you're going to make a 95,000 rupees gain, but at the cost of the premium, which is 15,000. So your net gain will be 79,000. Now exporter, was unhappy because the dollar has gone down to 82.05 because the dollar was trading at 83 at the time when you booked the transaction. So you are unhappy about it, but still you're going to get some money. So it will make you happy. So you're going to get 79,000. So any loss in the spot market, spot market will get offset in the stock exchange market. So you're going to get 82 lakhs 84,000. So he is hedged at 82.84. That is 82 lakh 84,000 divided by 1 lakh. So price comes to 82.8475. Now this can be worked out again. What is your strike price minus the premium? So that will be your hedging price. Okay. So if you want to calculate, take the strike price minus the premium is your basically your hedging point. So this is the money which you're going to get at any cost, even if the dollar falls. Then suppose the dollar has gone up. Now the dollar has gone up. You were betting on the dollar to fall. So it has gone the opposite way direction. So you say, no, I'm not going to exercise my loss. I'm not going to exercise my right. So what are you going to lose? You're going to lose the premium, 15,250. Okay. So now in this case, you don't have to pay any margin since you have paid a premium. Okay. So that is the only money which you can, lose. So, and the writer can lose any amount, but the option buyer can lose only the premium at the most. Okay. So you don't have to pay any margin. So exporter will receive 84 lakhs on 26th of March at the spot rate. So because the rate was 84, so he's going to get 84 lakhs from the bank. So he's going to get $1 lakh in the bank, and the banker is going to convert them into rupee and giving them 84 lakhs. So the net inflow would be 84 lakhs minus the premium, because of course the rate is higher, you are very happy about it, so you got more money, so you didn't exercise your right, and so the only loss for not watching the movie is the ticket price. So similarly, you lose the premium here, 15,250. So that means he gains on appreciation of the dollar. So that is, that's all. So let me understand whether you have followed, or let us move forward further. No excess not exercise, premium is lost. No, I mean, there is no interest cost called premium. Of course, you can always calculate that because you paid premium upfront. Okay, so you can do that. So let's see some question on the CA final which has come. One question we'll do. Okay, so let's do that question and let's see how they have done it. Okay, so I'm just moving on to the practice question straight away. So it's good that we have moved to the question straight away on the option. So this is again a question which came in on your CA final study material and came in one of your exams. So please follow. This is the last question we are going to do for the day. And then a day after, we are going to start the fate of the contracts. And if time permits, we'll do some more questions on the options. Okay. We'll do one question which is clarify all your doubts here. So XYZ Limited. Okay. So XYZ Limited, a US firm, will need these many pounds in 180 days. So they are going to receive 3 lakh pounds after 180 days. In this connection, following information is given. The spot rate is given, 1 pound is equal to so many dollars. 180 days forward rate is given pound as $1.69. So this is the forward rate. Okay. The interest rates are given, 180 days deposit rate in UK and US, and 180 days borrowing rate between UK and US. So both the rates are given. Okay. So you can just take a note of it, because I think the assignment has not been shared with you. So you can just, take a note of it. Okay. Take a pick of that, or just write down on a piece of paper. A call option on pound that expires on 180 days has an exercise price of $1.97 and a premium of $0.04. So I'm just pausing for a while. So please note down the details. I'm just going to repeat. So there is a company called XYZ. This is a US firm. They're going to receive 3 lakh pounds. Okay, after 180 days. So today the spot rate is that 1 pound is equal to $2. And after 180 days, that means the pound is depreciating and he's going to receive pounds. So that means he's going to receive less money, compared to what he would have received on a spot rate. So it is 1.96. Now, interest rate is there for 180 days for deposit rate as well as the borrowing rate. Now, a call option on pound that expires on 180 days has an exercise price of $1.97. Okay, so the strike price for a call option, since you are an exporter, okay, so you are an exporter, okay, so as an exporter, the call option is given, okay, expires on 180 days. So you are going to buy a call option, isn't it? Okay. Fine. So this is the exercise price and a premium. Now, XYZ Limited has forecasted the spot rate of 180 days, hence as follows. Okay, the future rate. So the future rate they have done is that what will be the rate after 108? What will be the spot rates? So which is $1.91, 25% probability $1.95, 60% probability, 2.05 dollar reaching is 15%. So that makes 100%. Which of the following strategies should be most preferable to XYZ Limited? A forward contract, a money market hedge, an options contract, no hedging. Show the calculations in each case. Okay, so this is what the question says. So you just can note down. So, XYZ has actually the forecasted the rates for 180 days. That the future rate, which is going to be there after 180 days, will be, there is a 25% chance that will be 1.91. There is a 60% chance that will be 1.95. 15% chance there will be 2.05. So whether you should go for a forward contract, money market hedge, options contract, or no hedging. Okay. So let's talk about first the forward contract, which is a simple straightforward. So we know that the forward rate is given as $1.69. So 3 lakh pounds into 1.6, so we get 5 lakh this thing. So let's go back here. See the rates here. The forward rate is that 1 pound is equal to so many dollars. So we need a pound rate and we are going to get pounds. So it's a pretty simple that we multiply 3 lakh pound with 1.96. We will get the, so it's a very easy one. So we multiply 3 lakh pound with 1.96. Okay, fine. So if we just go back again and just see the US firm. So it's a US firm and the rates are given like that. Okay, fine. So now let's talk about money market hedge. In case of imports, the money has to flow abroad. So remember this. So you don't have to remember, the formula. It's a very simple game. In money market hedge, if you are an importer, that means you're going to, send your payment abroad. So money has to flow abroad. So here, your home country is US. So you're going to borrow in US and invest in UK. Okay. And when whatever money you have invested, that will be sufficient to meet out your foreign currency, liability. So similarly, this is in import. In case of imports, okay. In case of exports, money has to come to back to your home currency. So you are going to actually do just the opposite. Okay. So borrow in here, you are going to borrow in US dollars, home currency. Fine. So you are going to borrow in home currency and convert the dollars into pound at the spot rates and invest the pound so that the amount grows to pay off the pound liability. Okay. Since you are going to pay money in pounds, so that will take care of your pound liability. Home currency loan which you have taken, which is in dollars, plus the interest will become your cost of imports. Okay. So you are an importer. Okay. So when you are an importer, so the cost which you are paying, which is the principal amount which you are returning back on the loan, plus the interest will become your cost of imports. Okay. So as an importer, fine. Okay. So let me just go here. Money market hedge, borrow dollar, convert to pound, invest pound, and repay dollar loan in 180 days. So that's what you are going to do. So amount in pound to be invested would be, so how much you're going to invest in pounds? So there is a 4.5% rate of interest in, interest rate is, if you see at the bottom, 180 days deposit rate in UK is 4.5%. So you will go to UK and invest how much? 2,87,081 pounds. Okay. So after, 180 days, it will become 3 lakh pounds. Okay. So this will be equivalent to pay off your liability in pounds. Okay. Fine. Now, when you borrowed this amount, you converted this amount into dollars. Okay. So borrow in dollars. So that means you need to borrow this much. So that means you have to borrow this much amount. So we just backward calculate. So you have to borrow 5,74,000. Okay. When you convert that into pounds, it will become 2,87,000. You're going to invest that money in UK so that it grows to 3 lakh. So think in the just opposite way. So how much you need to borrow? 5,74,000 in US. So the question, if you look at this, so you have to, if you look at this window here, borrow in US, okay, and invest in UK. Fine. So you're going to borrow in US. So you have to borrow in US. So which means how much you have to borrow? 5 lakh. So first of all, you have to calculate how much you have to borrow. Okay. So you calculated that it was 5,74,162. How? At the spot rate when you brought this money in US, it was 5,74,160. So the spot rate is 2. So that means the money which you are going to invest will be equivalent. So it will be 2,87,000. So you are thinking that you're taking money back to England, so it will be 2,87,000. So you borrowed for 5,74,000, convert that in pounds, okay, and take those money into UK and invest there. So after 6 months, it will become 3 lakh pound, which will be equivalent to the amount that you have to actually pay to your supplier. Okay, so this is the way. And then $5,74,000 which you bought, which you borrowed, you have to pay interest. So interest rate is 5.5% in US, sorry. So and the spot rate is also given there. So interest on principal will become the total amount will become 6,05,741. So this will be your cost of imports. Okay. So so in this slide, spot rate 1 pound is $2, which is given, which we have used in the third window for converting our dollars into pounds. Okay, fine. So this is what we have done. So this is the answer. That means 6,05,741 would be your total output using the money market hedge. Now let's talk about the call option. A call option on pound that expires in 180 days has an exercise price of $1.97 and a premium of 0.04. Okay. So let's look at this chart. Is it visible? Oh, yeah, is there. So now look at the expected spot rate, which is given. Okay. Now there are 3 expected rates which are given: 1.91, 1.95, and 2.01. So if you go back to the question, and you can find here it is. Okay. So this is the rate. Look at the third box. Okay, look at the third box. It is 1.91, 25% chance, $1.95, 60%, and 2.5, 15%. So we have put this calculations here. Okay. So we have put this here. Okay. So 1.91, 1.95 in the first column, and 2.05 in the third, row. So first row 1.91. So expected spot rate in 180 days per dollar. Okay. Days. This is the dollar rate. Okay. Fine. And the probability is given in the last second column. So this is the probability. Okay. So this is the probability which is given. Okay. So this is there. Now, how much premium you are paying? 0.04. Okay. This is the premium what you're paying. Okay. So at a strike price of 1.97, you are paying a premium of 0.04. So 0.04 is your premium cost. So when the strike price you're chosen is 1.97. Suppose the spot price closes at 1.91. Will you exercise your right? No. So since you have taken a call option, you will make money only if the spot price goes above 1.97. So since the price has fallen below 1.97, it has closed at 1.91. Okay. Then you're not going to exercise your option. So how much money you're going to actually be your cost, which will be the 1.91, which is the spot rate, plus the premium. Okay. So you're not going to exercise the call. So this is going to be your cost of your imports, and this is going to be a premium. So your total cost will be 1.95, dollar per pound. So the total price per pound will be, for 3 lakh pound, it will be 3 lakh multiplied by 1.95. So it will be 5,85,000. And the chance of this is 25%. So we have written 25% of 5,85,000. Similarly, if the spot price closes at 1.95, Again, this is well below the strike price, and you're still not interested. You're not going to exercise your option, so you're going to lose the premium. Okay, so your total cost will be the premium plus the spot rate on the expiry. So it is going to be 1.99. So if you convert that into dollars, into pounds, it will be 5,97,000. The probability of this event happening is 60%. So that means that it will be equivalent to $3,58,000. So the last option, that the strike, it closes the price of the dollar closes at 2.05. Now in this case, since it has closed above the strike price, so you are interested in exercising your option. Okay, so your total price per unit will be, we can just calculate at the bottom. I'm just bringing at the bottom. So let the screen appear. So it is 2 point. Look at the bottom. The gain in the options contract. Okay, the gain in the options contract is 2.05, which is the spot rate, minus the strike rate, which is 1.97, minus the premium. Okay, so that means he's going to make a gain of 0.04. Okay, so net outflow will be how much? 2.05, which is going to get, the money he has to pay, and then he is going to reduce the premium. Okay, so that is his gain. So that means his net cost will be 2.01. So the outflow will be, 2.01 multiplied by 3 lakh pounds. So it will be 6,03,000 pounds. So chances of this is 15%. So that means overall, all the chances put together, the outflow will be 5,94,900. Now, since he has to pay a premium of 3 lakh pound, okay, 3 lakh pound is the total amount. Premium is 0.04, dollar. So if you multiply by this, so it comes to 12,000 is the premium, and interest rate is 5.5% on that. So this money will get blocked for 180 days. So you calculate what will be my interest cost. Okay, so the interest cost comes to $660. So you add this up. So your total outflow, expected outflow will be 5,95,560. So now, so this was basically when you were using a options contract. Now, when you're using no hedge strategy, so you will simply take the expected future spot rates. Okay, then the dollar needed at those rates, probability, and dollar expected, third column, just multiply them and total up. So that means it comes to 5,86,500. So I'm just going to explain that. So these are the three rates which are given. Okay, and this is the probability. And 1.91, if you convert at the spot rate, 3 lakh pound, it will become 3 lakh multiplied by 1.91, it comes to 5,73,000. Similarly, 3 lakh multiplied by 1.95 becomes 5,85,000. So altogether, this is the amount which you're going to pay in dollars terms, but multiplied by the respective probabilities, this amount will come to this, and you just simply add them up, it becomes 5,86,500. Okay. Now, if you see all the options. So in case if you have not followed, maybe on the last day, I'm just going to take you through again this example. We are just coming very close to it. So maybe with a fresh mind, I'm going to attempt to answer all your queries regarding this question, because this is a very important one. So total outflow in all options will be forward contract $5,88,000, money market hedge $6,05,000, currency option $5,95,000, no hedge $5,86,500. So if you look at all the options, you find that which is the cheapest one, no hedge. So no hedge strategy appears to be the most preferable because least of the number of dollars are needed under this option to arrange pounds. So this is the question which we have done on the options. So let's see if there's some quiz before we close. We can have some quiz. No quiz, the quizzes are not there in this. So I'll just look for some kind of questions. So we are just coming to the end. I know that this is the most difficult one, and you will have a lot of questions. So I haven't received because it's a topic which takes time to. So just go and watch the video properly. The last question, which is options, okay, and come back with your queries day after when we meet again. So when we will be doing fate of contracts and most accounts. So along with that, you come up with queries on this question. If you understand this question, you can solve any questions, option questions on the world. So you don't have to go any further. Okay. Fine. So if you understand this, question, then there should not be any problem whatsoever. Of course, there is one question on swaps, which we are going to do again on the next time we meet. Okay. So please go and watch the video, particularly the option question. Okay. The first question, which I shared with you on stock market options. And then I explained one question which came in the CA final, which is there on your screen. Okay. So this was the question. Okay. So just go through the video at least 2 or 3 times and come back with your queries. So options. So now options, please summarize. So in case of options, what happens is that it gives. Now what is the difference between futures and options? So in futures, you can make unlimited potential of money, as well as you can lose an unpotential of, you lose unlimited potential losing money. Whereas in options contract, particularly with respect to the context of currency options and currency futures. So currency futures will hedge you. So whatever happens, your rate is fixed. If the rate goes up of the dollar, suppose you are an importer, for example, let's say you are an importer and the dollar goes up. Okay, if you have gone to the futures market, so what will happen? You are not impacted by the dollar price going up because you're hedged. Even if it goes down, you're still not worried because whatever price at which you have bought the option, futures, that will become your hedging price. But in case of an options, because you want the benefit, if the dollar price goes down as an importer, you're going to make money because you're going to pay less. So you want that thing to happen. But if the dollar goes up, you don't want the loss. So as an importer, if what happens is that when you're exposed to a foreign currency transaction, when you're an importer, when the dollar goes up, you have to pay more money. When the dollar goes down, you have to pay less money if you're not hedged. But when you're hedged, okay, as a futures, so as an option particularly, so when the dollar goes up, you don't have to pay a higher amount. You are hedged because you're going to make money in the options trade. Okay, that will offset your losses in the real trade. But when the dollar goes down, you don't exercise your right, which means that you take an advantage. When the currency moves in your favor, you just move out of the contract, and just the cost of doing that is the premium. Okay, but in futures, you don't have that advantage. In futures, if the dollar goes down, if you're an importer, you're not going to capture the benefit of the dollar going down. Okay, because you are hedged at the rate at which you have bought the futures. Okay, even if the price goes down the dollar, you're not going to get the benefit. But in export, you're going to get the benefit of that, because in that case, you're not going to exercise the right. Okay, but if the price goes up, you're going to exercise the right and you're going to get all the gains, which will offset your losses in the real market. So that's all. See you then. I hope got it right. So okay. So that's the end of the day.